Welcome to This Explainer. Today, we are doing something really cool. We're exploring the literal anatomy of a business by breaking down the fundamentals of corporate finance. If you've ever stopped and wondered what actually keeps the lights on, the assembly lines moving, and the innovators dreaming in the corporate world, well, you're in the exact right place. We're going to peel back the layers and look at the financial mechanics that make the whole shebang possible. So let's just dive right in with a super practical question. How does any organization actually survive, operate, and grow day after day? I mean, you might have the greatest product idea in the world, or literally the most talented team on the planet, but without a steady, well-managed flow of funds, everything grinds to an absolute halt. The success of any business depends entirely on how efficiently it generates and uses its cash.
Henry Ford actually hit the nail on the head here. He captured the stakes perfectly by comparing money to a physical limb, basically proving that finance isn't just about boring spreadsheets and numbers. It's the physical capability of a business to act. It's the lifeblood. It's the muscle. If you don't use it efficiently, you literally lose your ability to function in the market.
All right, here's a roadmap for today. We're going to cover what corporate finance actually is, 2 crucial decisions every manager makes, why this all matters, the difference between fixed and working capital, and finally, we'll unpack capital structure.
Starting us off with Section 1. What exactly is corporate finance? I really love how Henry Hoagland defines this. He boils corporate finance down to just 2 wonderfully simple actions: acquiring capital and using it. But, within that simplicity is a massive scope. We're talking about financial planning, studying the capital and money markets, and working really closely with banks. The finance manager's ultimate job is to make sure the firm has adequate funding, uses the absolute best sources at the lowest possible cost, and, at the end of the day, generates maximum returns for the owners.
Moving right along to Section 2, 2 crucial financial decisions.
So, if you're the finance manager, your job basically comes down to a high-wire balancing act. First up, you have the financing decision. Do you issue equity, take on debt, or hit up the bank? You need the right amount of capital and the exact right combination of sources. Then, once that capital is securely in hand, you pivot to the investment decision, which is also known as capital budgeting. This is where you systematically deploy those funds to guarantee a return that actually beats the cost of getting that capital in the first place.
Which brings us to Section 3. Why corporate finance matters.
Think about it. Finance touches literally every single nerve of the business. It coordinates all the different activities. You just can't make a major strategic move without checking if it's financially viable first. When your corporate finance is organized, you can confidently raise capital for big new projects, which then funds vital long-term research and development. That R&D upgrades your products, letting you run smoothly, pay salaries on time, and, this is a big one, maintain a solid buffer so you can successfully manage unexpected risks like sudden strikes or natural calamities.
Let's look at the different types of money involved in Section 4, fixed versus working capital. Check out the striking difference here. It's kind of like looking at 2 different species of money. Fixed capital, that is permanently locked in. We're talking massive factory floors and heavy custom robotics. It's for the long haul, so naturally it carries way higher risk. Working capital, on the other hand, well, that's your business's circulatory system. It's the cash right there in the register and the raw inventory sitting on the shelves, used strictly to handle day-to-day operations and just keep the business breathing.
Looking at this breakdown, you really see how these 2 live in totally different ecosystems. I mean, you obviously wouldn't fund a 20-year factory build using a 30-day short-term loan, right? Long-term assets require long-term funding sources, things like issuing shares or debentures, because investors are looking for future profit down the road. But short-term cash for immediate operations, that relies on trade credit or short-term bank loans. Mixing these 2 up is a classic and sometimes literally fatal rookie mistake for finance managers. And that leads us to our final piece of the puzzle, Section 5, Understanding Capital Structure.
John Hampton defines capital structure as this specific relationship between debt and equity. It's essentially the ultimate security mix. Basically, whenever a company raises long-term funds, it has to decide on a ratio. How much of this money are we actually going to own, and how much are we just going to borrow? You can think of a company building this financial skeleton using 4 distinct pieces. First, you've got equity shares, where investors take on the ultimate business risk for a slice of the profit. Then you have preference shares. These essentially let investors skip to the very front of the line for repayment and dividends. You also have retained earnings, which is basically a company betting on itself by reinvesting its own past profits. And finally, external borrowed capital, like heady bank loans and debentures.
By tapping into these dynamic capital markets, a company has to meticulously balance that debt-to-equity ratio to create a safety cushion. Because if you rely entirely on borrowed money, just one bad economic quarter or a random supply chain glitch could force you straight into bankruptcy. But balancing it perfectly, that buys you stability. And, much more importantly, it gives you strategic flexibility.
So, to wrap up our explainer today, I really want you to think about how you'd put all these principles into practice. Imagine you're sitting in the finance manager's chair. How would you structure the financial skeleton of your own business? Based on the unique risks of whatever industry you're in, how much would you comfortably borrow and how much would you demand to own? Ponder that for a bit, because getting that single ratio right can absolutely determine whether a business thrives for a century or closes its doors in a year. Thanks so much for joining me on this explainer, and keep learning.